In this video, we are going to be analyzing the Albany rental market for multifamily properties. And as you can see, we are in Albany, New York, the capital of New York State. You can see New York City down here, Long Island, Connecticut, Rhode Island, there's Boston, Massachusetts, New Hampshire, and over here is Toronto. So you can kind of get an idea where the Albany metro statistical area is located. So let's look at our filters, and as usual, we are excluding all corporate, all military, all senior, and all vacation, and we are only including market and market affordable, so we are only looking at conventional apartments. If we go to location, you can see that we are in market, metro statistical area, Albany, New York. So let's take a look and see what the analytics tell us. Here is our supply snapshot for the market. There are 2,183 properties, 59,121 units. There is still 1,918 under construction, and 370 more people left the rental market in the last 12 months than moved into the rental market. And we can see that by the vacancy increasing from 2.5% to 4.7%. The market rent per unit is still showing a slight increase year over year, but we will see what it looks like quarter over quarter. As usual, we will not be looking at the capital markets. We are only looking at the space market. If we come on down and look at our long-term occupancy average, we can see that over the last 22 years, the long-term average is 94.77%. And the market is currently sitting at 95.29%. So slightly above that long-term occupancy average on a market that had a little bit lower of a long-term occupancy average. I would say that this would actually be on the long-term average, but because this vacancy is so low on a long-term basis, we would consider this slightly above it. So let's see if the data confirms that. So let's go take a look at our Class A, B, and C combined data, and then we'll look at the A's individually, the B's individually, and the C's individually for conventional apartments in the Albany, New York metro statistical area. So here is our analytic data. We will not be looking at asking rents. We don't care what the owner is asking. We only care what they are collecting. We can see that in the first quarter of 2022, they were getting $1,399 a month, went up to $1,433, up to $1,438, and then down to $1,433. So the market seems to like that kind of $1,433 right there. At least it's trending back down in that direction. And of course, the effective rent per square foot has not changed in 3 quarters. So a little bit of a stabilization here. So that's interesting with that negative absorption. Let's scroll over and see what our deliveries and absorption tells us. We had 291 deliveries in the first quarter, and we absorbed more than what was delivered. That is what we call a nice strong market. But then we had no deliveries in the second quarter, and we lost 197 to absorption. So 197 more people went out, or 197 more units went vacant than occupied in the second quarter. Delivered 369 units, so 369 units were delivered vacant to the market, and an additional 362 units went vacant. Another 137 delivered vacant, and another 208 delivered vacant. So we can see a steady downtrend in the occupancy. So it's interesting that our rents are adjusting the way they are, how they go up, 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 and then slightly down. I would have expected to see this downtrend a little sooner than that. But again, this is a very tight vacancy market, so it's not that big of an anomaly. Let's see what the Class A space is doing and see if we can't identify which asset class is bringing this market down, if any. So here's our Class A data. There are 38 properties in the market totaling 4,482 units. Again, we'll be looking at effective rent. The Class A's started at $1,817, went up to $1,899, pretty big jump, and then down to $1,877 and down to $1,868. All right, so we can definitely see a downtrend last 2 quarters versus the overall, which was only trending down the last quarter. So let's see what our deliveries and absorption tell us. So we had no deliveries in the Class A space, which means all our deliveries must have been in the Bs, and the people are just leaving this Class A space. Now, keep in mind that there aren't very many people leaving, and there's 4,482 units. So small numbers, but the fact is they're not absorbing, they're not moving in, people are moving out. So that explains why our Class A rents have been declining for the last 2 quarters, and that would make sense. But keep in mind, we are still well below our long-term occupancy average here, or well above our long-term occupancy average. So I would anticipate that these rents will stay fairly stable here to try to bring it down a little bit more to stabilization. Although the renters are saying, look, we want to come down to that point anyway. So not too much of a surprise for Class A. Let's see what the Class B looks like. Here is our Class B data. Again, we will be looking at effective rent. There are 447 properties in the market, totaling 27,103 units. In the first quarter, they were at 1488, went up to 1524, very slightly up to 1527, and then down to 1517. So a little bit of a downtrend there heading into the fourth quarter, similar to the overall. So let's see what our deliveries and absorption tell us for the Bs. So we delivered 291, absorbed 354. So we saw that in the combined inventory when we looked at A's, B's, and C. And it's pretty much following exactly the way it did with all 3 asset classes together. So it does look like the B market is trending exactly the way it was when we looked at overall for all 3 asset classes. So not too much of a surprise here. We've gone from 97.6 and steadily down to 95.2, so getting close to that long-term occupancy average. So not a whole lot of downtrend here, but some downtrend. Could continue as it gets closer, although it's almost at that long-term occupancy average now, which is kind of where this market likes to be. And not too terribly bad of negative absorption, though it is negative absorption. So we do have some people either leaving the Albany market, which could be an indication. We do know that there are people leaving New York. They are moving out of the state. So they could have left, or they could have doubled or tripled up. So let's take a look at the Class C space and see what it tells us. And here is our Class C data. We have 1,627 properties in the market, totaling 27,177 units. We're looking at effective rent, and in the first quarter of 2022, we were at 1157, went up to 1178, went up to 1193, and pretty much stabilized right there, 1194, only $1 uptrend as it continued up. Now, the interesting thing here is that vacancy has definitely ticked up. Tells me we've got negative absorption in all 4 of these quarters, but we're showing rental increases. Now, keep in mind that we are still above that long-term occupancy average, so I cannot blame ownership for continuing to rise rents in this case because we still have very little vacancy in this market. So let's see what the absorption tells us, because we should not have deliveries, and we do not. And as I suspected, we do have negative absorption in all the quarters. Okay, so this is no surprise. We've seen this in a lot of places in the country. Some have been doing it unethically because they are already below that long-term occupancy average, so there's definitely no demand to be doing it. But in this case, we are still above that long-term occupancy average. So I cannot fault the ownership for doing that, because when you have vacancy that does not equalize or get to that stable market, you raise rents until you get there. So cannot fault them for that. So Albany is just kind of trucking along. Let's look at, we'll just kind of scroll down just a little bit here. We can see that when we look at effective rent growth is pretty small. We did have some negative rent growth in 08, but just slow and steady is the pace. All the way up, we did have some bigger numbers in 2022, but those are an indication of the difference between 21, 22, where we had some really large rent bumps. So, another market, we looked at Milwaukee yesterday, and Milwaukee, same thing, slow and steady wins the race. Albany, we're kind of seeing the same thing, slow and steady. It is coming down a little bit, but not too bad. No reason to really go look at the other asset classes. I would assume they're probably going to be the same. So pretty much confirms that we are still slightly above that long-term occupancy average in the oversupply side of the market, because we are seeing negative absorption. But Albany seems to be holding okay compared to some of the other markets we've seen. So that's going to do it for our rental market updates for this week. If you guys would, please make sure you subscribe to the channel, like and share these videos so that everybody can get the truth about what's happening in the marketplace right now. When we come back next week on Monday, we are going to be looking at Indianapolis, Indiana. I'm really excited to see that market. Then we're going to do Grand Rapids, Michigan on Tuesday, Omaha, Nebraska on Wednesday, Rapid City, South Dakota on Thursday, and Cincinnati, Ohio on Friday. So I look forward to seeing you next week, and have a great weekend.